Hello, welcome back. Oh my God, I can't believe it's been it's been a hot minute since I've been here live. How are you? If you were here for your live dose of real estate reality, my name is Jackie Baker, and I'm a real estate agent serving Northern New Jersey area. And this is my live stream. I was doing this weekly a while ago. I think we're going to be going to like bi-weekly. Because you know what? I feel like I'm talking about more of the same stuff every week. Because let's face it, the market has not been fun. So anyway, thank you for joining me tonight. The topic, obviously, you saw from the thumbnail. It's we are now at 8% mortgage rates. Yes. Now look, it could be worse. You could be, it could be like the 1980s. If you didn't catch my video that I posted yesterday, it was all about how this housing market is going to be more like, well, some experts from Bank of America are saying that they feel this is a repeat of the early 1980s when interest rates hit 18%, yet prices still went up. Okay, so we're still in that same thing right now. Prices are still rising. They are, even though rates are hitting 8%. And every day I'm like, who's got the money to buy all these, like to pay for this right now? It's unbelievable. So anyway, I have Bob Wilderotter with me. All right. We were having technical difficulties. That's why I'm running a little late tonight. All right, Bob, I hope this works.
Hold on.
Yay.
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 All right.
Bob's here. Thank you, Bob.
I'll just have to hold my phone all night, but I could think of worse fates.
Exactly. Listen, we get to hear you. That's what's important. So
yes.
Thanks for being here. So anyway, rates are, you like to call it the snowman rate.
It's like my golf score when I triple bogey on a par 5. It's called a snowman when you got to put a little snowman in and people just walk away in disgust. So we've been touching on the 8s. Particular buyer classes are going to be looking at in the 8% range. Those with the best credit out there. I'm going to kind of get into the 4 quadrants of the buyers that are out there.
Yes.
And who's getting the better opportunities versus others. Life is never fair, as we know.
I know. Yeah. I mean, it is really tough right now. But what I'm still blown away with is the prices. The prices are just going through the roof. I mean, you and I are now working with a mutual client. She looked at a townhouse this weekend and it was at her max spend, right? So we got the pre-approval for her, and then only to find out, which I knew this was going to happen, it went into multiple offers and there's a bidding war. So now she's like, I'm not even going to bother making an offer because I don't want to overspend. Totally understand that. But yet now townhomes are like, in North Jersey are over $700,000. I mean, it's ridiculous what this has turned into. And it's like, I mean, how much longer is this going to be sustainable? Because the incomes aren't going up as high as these prices. So, it's just becoming more and more discouraging. And I'm glad that you decided to join me tonight so we can share with people some information, maybe, just to show them what is this going to cost them now, right?
Okay.
How is this all going to break down for the average buyer right now? And that's what I get all the time. And I'm going to share a couple of comments later from my viewers on the video. People who viewed my video yesterday. They had some very interesting takes on what's going on right now, and I wanted to share that. But anyway, I digress. So, Bob, I got your presentation that you had sent, and I'm going to share that. Do you want to get into that right now? We can.
Yeah, sure. And if any questions come up while we're talking, just interrupt me, and we can do a deeper dive on it and explain better.
Yeah. So if you are watching live right now, please comment. You see, got a question, post it in the comments, put it there. I will be monitoring, and then I can stop Bob and I'll shut him down and have him answer the questions. So let me get your presentation up here, Bob. You did such a lovely job with it too. Thank you very much. Let's start at the beginning. So tell me, hold on a minute. Can you see it, Bob?
Yeah, I see it. Yeah.
Okay. Yeah. So just tell me, we'll just start at the first slide. You want me to just go through each slide?
Well, let's go to the beginning so people understand, where I work, how we work together at times, and so forth. So who I work for is Guarantee Rate Affinity. Guarantee Rate is the second largest lender in the country, if not the world, for residential lending. So for mortgages. So it's a specialty lender, meaning that they're really dedicated to the purchase market. When refinances are there, we do them, yes, but we've always been in shoulder to shoulder with the realtor community. The Guarantee Rate Affinity is a half owned by Guarantee Rate, and the other half is owned by Coldwell Banker. So I joined them back in December of 22, and it's been exciting. They've got a lot of tools here, but nevertheless, it is, no matter where you go, it's really the same sort of problems are hitting everybody. So I'll go to the challenges what our buyers are dealing with right now. So our mortgage rates. You go next slide, Jackie.
Okay.
Mortgage rates are at a 16-year high. So we're in the low sevens with a couple of points. You're in the mid to high sevens, maybe with 1 point or none. If you sharpen the pencil, we can really get it in there. What we have also are a lot of homeowners stuck in place. So these folks, we did such a good job, during COVID and just prior to COVID, and after the great implosion, the housing recession that happened, we got everybody out of that we could out of their 5% and 6% rates into 2% and 3% rates, and now here we are 3 and 4 and 5 years later, and the sellers are reluctant to sell because they love those rates they've got. And so where are they going to go next? So wherever they go next, the equivalent spending power, if they wanted to keep their payments at $1,000 a month, and that was a $200,000 mortgage at a 3% rate, that's now, would have been a $300,000 mortgage. So it essentially cost, hundreds of dollars more for that same money, and it's more difficult for them to downsize. So that's a challenge. And then another big challenge are the closing costs and down payment combinations. So there's a lot of buyers out there floating around, they have $20,000, $30,000 saved up, which normally we can handle. Actually, we can handle that all day long. The sellers, on the other hand, when you have multiple bids, are less kind to these buyers because they like to go with people with the larger down payments, cash buyers, more certainty. So that's it's really been difficult, for the first-time home buyers, with a little bit of hair on them, as we say. They're having the biggest problem of all. The next slide. Here's your cost per thousand. There's no sense going backwards in time. It'll just make everybody feel bad if I show them what what $500,000 would have cost. Like 3 years ago, it's just rubbing it in. But here's examples, for 100, 200, 300, 400, 500. I mean, we're not getting, I tend to get larger loan amounts in the market that I'm in, but, on the whole, the average loan amount in northern New Jersey is between 300 and 400,000. So right there, you're between $2,100 and $2,600 a month, plus your property taxes and home insurance. And you add that on top of there, so you could easily be $3,500 to $4,000 a month if you're trying to borrow $400,000 on a $500,000 house. But now those $500,000 houses are probably closer to $700,000, so that's another challenge.
I know.
The genesis of all this, I think, is when we had that the great short and all the housing got destroyed back in 2008, 9, 10, 11. A lot of the builders went bust, or they decided to get into other business lines like rental properties. So they started building multi-family units, that were apartment rental buildings with hundreds of rental apartments, and would just get financing based upon the rental cash flow. We did not get a lot of developers putting up homes for sale. Those that we have are high end. Take, for example, the ones on Lake Street, should have been a good answer for people to downsize from Saddle River and Franklin Lakes and so forth. But those are now 1.3, 1.5 million, and the taxes are 16,000, and the association dues, I want to say, are probably another 1,500. So
It's ridiculous.
it's not a
It's
real ideal
no.
downsize.
No,
It's
this
just
is we don't downsize. We don't stay in northern New Jersey if we're
no.
downsizing. Let's just face facts. That's not happening. We can't do that. So yeah, that's so if anybody's watching from another part of the country, yeah, Jersey's really hard right now. It's very, very expensive. And I just yeah, it just sucks. Bob, one thing I wanted to ask you, somebody brought this up with me the other day. Are you still seeing or hearing about people making what we used to call them the fake cash offers, saying that showing that your bank statements that you have cashed in and you're getting loans on the back end, you're getting a mortgage on the back end?
Yes, yeah, I've come across that. There's nothing wrong with that. It's more efficient. If someone truly has, and that's even with larger down payment buyers that don't really want to put all that money down, what they're showing me is they've got enough for 20, 25, 30% to put down, but they know the house needs work or they got to furnish it. So ideally they'll want to end up only putting out 10%. But
Okay.
we have that fail safe, and if the house did not appraise for the price, which is always a seller's fear that 30
Mm-hmm.
days later the buyer's going to say, oh gee, sorry, guess what, it underappraised by 25 or $30,000, and I don't have that money, and I'm
Mm-hmm.
sorry, I can't go through with this anymore. So the seller's faced with a dilemma. They're going to have to either put it back on the market, and you get that what's wrong with it sort of look,
Mm-hmm.
or they're going to have to take a haircut on their price, which they were not going to be happy about. So that goes back to the low down payment buyer being considered riskier. So
Mm-hmm.
uh, you kind of, you described it as 100% cash buyers, but I would describe it where I use it is where I've got buyers with potentially 20, 25, 30% to put down.
Right.
And then, once the appraisal comes back and I show up with a commitment for 90% financing, nobody cares at that point.
Okay. See,
Okay.
what we had seen, like, and I had this happen on a listing last year where the people they said they showed us a proof of funds. The house was they're paying, I think it was 590 for the house, and they were saying, we have the cash, we have whatever. Come to find out, the bank account belonged to somebody else name was on the contract, right? That they were going to be buying the house. They came back to us and said, "Oh, we're going to remove that person off we don't want their name on the deed, so we're taking them off the contract." Only to find out that the people really buying it were getting a mortgage behind the scenes, but they used that other person's bank statements to show that they had cash. And what the
Yeah,
plan, what
that's not kosher at all. That's
no, but what the
no, that
right because
that's fraud. Um,
well, what the plan was, here's what the plan was. They said they did so the excuse was, well, they just wanted to play it. They decided they didn't want to use the proceeds. They were in the process of selling their house in Ridgewood. And the excuse was that they didn't want to use all the proceeds from the sale. That's why they decided to go and get a mortgage. And I was like, well, wait a minute. I'm like, we come to closing, and if that house doesn't sell, now you tell me you don't have the proceeds. And they're like, no, 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 we have the cash. They do have the cash. They have the cash. They have it, invested in mutual funds, blah, 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 whatever. But that's the crap we were seeing, during the height the pandemic market, I like to call it. But people were doing that. They were showing bank statements to say, I got the cash, I'm paying cash just to get the damn house. And they would turn around on the behind the scenes and get a loan.
if it,
We almost killed the deal because of that. I was representing the seller.
if it's their cash, I would have no problem with that, Jackie, because all they're saying to the seller is, I'll see you on the 31st of December with my money or my mortgage, no matter what. I'll be there with a check.
True. Right.
Okay,
Right.
that's what they're saying. So they're not going to give themselves an escape hatch because they couldn't get approved for a mortgage or sell another house. Um,
Right.
So
Yes.
that's all legit. That's fine. And then they show up with a mortgage, also fine. But if they showed someone else's bank account as like a false,
Yeah.
flag, that it's an account they could tap when they never had access to
Right.
that money. It was just a friend saying, "Oh, maybe I'll spot you if
Yeah.
you're in a jam," sort of thing. But they never had any intention of providing that money. That's a
Right.
parent, grandparent, brother, sister. I would, or an adult child that has that kind of money. I would be all right with that. But if it's just, friend of the family, air quotes, or
Yeah, it was a
someone.
relative. It was a relative of some sort, but it was their bank account, and they had their name on the contract, like they were one of the purchasers, and then they turned around and removed them, and that's because they were like, "Oh, we're just gonna get a mortgage now." So it was
Yeah,
very shady. It was very, very shady. I did not like that at all. So
but they got the house, right?
yeah, they got it. I sold it, but
Yeah.
still, when I heard that they were doing this, I'm like, "Are you freaking kidding me?" Because then anything could go wrong. And even though they said, we have the money, they're still going to buy it. Just it,
Well, all is
whatever.
fair in love. What was it? Love and money, and now housing. All is
Yes,
fair
I will say,
in love.
yeah,
Yeah.
yes,
So
so
people got imaginative with how they were going to try to get their offer to stand out.
yeah, yeah,
So A for creativity and an F for ethics. You know,
exactly.
that's
Yeah,
that's where I go.
I was not playing. I was not playing that. There's no way I was going. I'm like, no. And if somebody came to me and said, "Let's do that," I'm not doing that. So just so y'all know, I don't play that way. All right, can we move? Getting back to this. Do we want to move on to the next one? The next
Yeah.
slide, Bob.
So the things, these are the pillars of lending. What we look at. These are the components of the quadrants of the buyers out there. Their income and their assets and their credit. I mean, we don't know what the appraisal is going to be, or even if we need one. Sometimes we get a waiver on the appraisal if Fannie Mae somehow has information about it because of a prior sale or something in the neighborhood, and we get that waiver completely random. It's like 1 out of 10 purchases. I get that
Yep.
type of waiver, which is always exciting.
Yes.
Um,
Love when
but
that happens.
the income where and I think one of your comments, commentators, that was saying what happens when the bottom falls out of the market, and I'm just going to educate everybody very quickly about what they have to go through, meaning the buyers, to get a mortgage in this day and age. Um,
Okay.
it's an audit.
All
It's a
right.
colonoscopy with no anesthesia, so it's both.
Yep.
It's we're going to know everything. So, a salary is considered guaranteed income.
Yep.
When people are paid commissions and bonuses, that's considered variable. So that gets averaged. So a lot of buyers will tend to round up to their best year and say that's what they're always making. But we're like, no, the rules say we've got to look at last year and the year before and average that over the last 2 years. And that's, not as aggressive as a number as a lot of buyers like to think. So we sort of knock them down a peg or two if they think they're really, you know, looking good there. Pensions, Social Security is considered guaranteed income. Um, Buyers that are paid hourly is considered variable income. So if they missed a lot of hours because of illness or furloughs, things like that, it's going to cause an average to happen. We can't just go that they're now working full time and they have an extra shift and now they're making more money than ever. It all gets averaged down. So overtime also gets averaged. And then the self-employed folks, they really get scrutinized. We're going to look at the last 2 years tax returns. So
Yep.
they are, telling the IRS, don't tax me, I'm so poor. Look at this. This is, all I have left over to tax. And then when they're talking to me and my lending brethren, they're telling me, look how much money I make on the top line. I really make a lot more. I said, well, guess what? The government owns all the outlets for the financing too. So which truth is true? You make
Hmm.
a lot of money or or you don't. So it gets averaged over 2 years. Rents, dividend, interest income gets averaged. Rental income is treated. A lot of people sometimes they'll leave a house that they're in and they say they're going to rent it out. In some cases, we can give them credit for that rent. In other cases, they cannot get any credit, that they carried it empty, and still qualify. Alimony and
Okay.
child support's got to last for at least 3 years. So we're looking at the ages of the kids and the date of the divorce decree to
Right.
see when that's going to end. It's a 3 year period of time from the day you close. So you got to watch those timetables.
Right. Okay.
Um,
All
and
right.
then
Sorry.
the assets, we were
Yep.
just talking about the assets. So there's your obvious checking, savings, and CDs, stocks and bonds, sale of assets, like you sell a car, motorcycle, a boat, sell another house. You can get gifts from relatives. That's permittable. There's down payment assistance programs, which are great, but we don't have sellers that are abundant in the price point where those folks can use the down payment assistance program. So that's been sort of a challenge. And then the two big no-nos are cash, can never use cash, and unsecured debt. You can't, go write check off of a credit card for $50,000 suddenly to put 50 grand in the bank to use for its down payment. That's not allowed.
So wait, why can't we use cash for down payment or closing?
Cash, like cash in a box, cash in the hole, like in the ground, in the
Oh, like
mattress.
under your mattress?
Yeah. So,
Oh, that cash. Okay.
yeah, that kind of cash, and that's because the Patriot Act, requires lenders to source all monies used in transactions to make sure there's not narco terrorists that are laundering their money through to buy all these houses or
Yep.
businesses, whatever they do. So, we cash is never acceptable.
Okay. Okay, cool. All
Okay.
right. All right. Then we got credit.
Then we got our credit, right? There's the three bureaus: Experian, TransUnion, and Equifax, and the credit score range is from a low of 400 to a high of 900. I've never seen below 480. I've never seen above about 830. So those are that's unicorn levels of being above an 830.
Okay.
FHA will, under exception basis, go as low as 580. Fannie Mae is more like 640. That's your conventional financing. Those guys, Fannie Mae, Freddie Mac, are going to want better credit scores, or they're just going to punish the hell out of you with all sorts of pricing penalties when your credit scores are not
Right.
up and over 760. And what affects your credit scores are your payment history. And I've had it happen where people were spotless for years, and then suddenly it went south. They didn't make a payment for whatever reason. In one case, an account was hacked, and my borrower, who was buying a house, had another mortgage on another house, and that mortgage went late. And because the account was hacked, and she forgot to reset up the auto draft, so it went 30 days late.
Right.
And we still managed to go through it, but it dropped her credit score by like 60 points.
Oh my God.
Yeah. So you can have one little dumb, go out to like Raymore Flanagan, take a special, forget to make the payment right in the middle of this process, and then your credit score can drop 100 points, which is
Ooh.
devastating. Yeah.
Hey Bob, really quick. Somebody's asking here. They said, can you please say that again regarding down payment assistance program? Did you mention?
Yeah. So there's the New Jersey HMFA, which offers $15,000 for down payment assistance to qualified buyers. That means first-time home buyers only. It means their income cannot be above, I want to say, 150,000 is the limit. I hear they're coming out with a higher amount. That $15,000 down payment assistance is actually a second mortgage that has no interest rate, no payments, and in 5 years it's forgiven.
Yep.
Okay, so that's called a soft second, and that could be of tremendous value. So for those of you that saved up 20 or 30,000 and you're trying to buy a house for 350 or so, and you only have that 30,000, you didn't have enough for closing costs as well as the down payment necessarily. Now this $15,000 helps out tremendously. So
Yeah.
that's the good news. What the bad news is that we have to go to the state of New Jersey to have them underwrite it. So it's going to add an extra month to the process.
Oh,
It's
I didn't
so
know that. I
oh
didn't
yeah,
know that.
yeah.
Okay.
It's not, no lenders have the signing authority. to rubber stamp these and move on.
Huh.
The state of New Jersey has to review the files. They want them in paper form. They want original signatures. They're still operating like it's 1980.
Yeah, of course.
Yeah. So they'll do what they
Come on.
do, and they just, they'll have their punch list of 28 things, and then they'll suspend it for the 27th thing. It does get done. It is successful. If you have time, it's all good.
If you have the time. I know that's the
if
thing.
the seller's willing to wait.
No, they don't have the time now. So,
Yeah.
so the same person had asked a question, thoughts on 760 credit score. And then they also wanted to know what's the interest rate for investment properties. In March, it was 9%.
Well, they're not 9% unless you were doing like a funky type of product where you weren't showing your tax returns. Like,
okay.
Yeah, that's I just quoted somebody today, 8 7/8, where you're buying like a rental property and it's just based off of the cash flow of the rental property. So in that case, he was pushing 9%. But someone buying, I would use FHA as an example because there's no price penalties with FHA on 2 to 4 families. Unlike conventional 2 to 4 families, they're adding another 2 points, 3 points, 4 points when it's a 2 to 4 family. And if it's an investment property, they're adding another 3 points. So you could have 5 points cooked into the price, which will put you into the 8s with probably 2.5 to 3 points.
Oh God.
I don't know if we can get you to 9, but
okay.
You're going to be in the mid 8s would be my estimate.
Okay. All right. And then they also said thoughts on 760 credit score. I'm not sure what.
Yeah. That's the new, sweet spot. So it used to be 740. There was no other bucket of pricing above there to get any sort of rewards on your pricing. If you're shopping loans, for example, and a 740 credit score got the best outcome. Not anymore. Now 740 to 759 is a bucket. At 760, better things happen. On a much smaller scale. So your pricing, what would have been, a rate that perhaps cost you a quarter of a point, maybe $1,000 for a $400,000 loan.
Mm-hmm.
At 760, that quarter point is not there anymore because you're rewarded with a 760 score. And then there's a 780 bucket. There's a whole grid that has, all, and you can look it up. It's Fannie Mae, FNMA.
I'm going to put it in here.
Yeah, LLPA chart, loan level price adjuster chart. That chart is going to show you, where they add on to the pricing. So if you're putting down 70%, like a huge amount, none of the price add-ons hit. But once it's like, 30% and less, you start to see some add-ons to the pricing.
Right.
And 20% is sort of like a kill zone. They're not very kind to 20% down payments, but they're kinder to people with 15% down payments for some reason. And they're kinder to people with 25% down payments. But 20% for whatever reason just gets spanked, even especially on condos. They're adding another 3/4 of a point for condos.
Unbelievable.
Yep.
Oh my God.
Yeah, it's all risk-based. So now, now that everybody figured out how to work Excel, they put all the digital like preferences or things that behave certain ways. So, oh look, we noticed that when it's a 3-family house and it's this FICO score and it's owner occupied, we have a 0.02% higher increase of defaults. So we're going to price that in. So it's all based on experience, and they really have granularized the pricing model because of all the statistics they have mapping this out over the last 20 years or so.
Right.
So it's gotten very very detailed. So what used to be 3 or 4 boxes 20 years ago is now 100 boxes of price variations and loan purposes.
Oh my God. Oh my God.
Yeah, like second homes, for example, vacation homes used to have no penalties at all. Now they do. Now you're paying an extra point or so for the privilege of buying a vacation home.
So why are they doing this? Why are we being penalized for that?
Several reasons. One, because they can. Uh, they're those who
Yeah.
have the gold make the rules. Number two is the defaults on second homes is slightly higher than primary residence, so they're considered riskier. So they're going to cook in a little
Okay.
extra juice to make up for the more defaults they expect to happen with second homes.
Mm-hmm.
And then they look at their charter. Their charter was to help the average taxpayer, first-time home buyer, buy a primary residence, create housing for families.
Mm-hmm.
Second homes, investment properties are out of their charter jurisdiction. So they sort of got, into that realm because they like doing all this business. And it gave them more, you know, bragging rights when they were adding, several billion more to the ledger when they were doing more, financing. But now for investor properties and second homes, they really have added a lot more penalties. They want to push it off to the private sector is really what the goal is.
Okay. All right.
Yeah.
Okay.
But there is no private sector. It's you can't compete against the government. That's always been the problem.
Yep. Yeah.
Um, Now, getting back to what
Yeah.
affects credit scores, your payment history, available credit. This is an easy. We had a client where we had this situation where they had way too much uses on their credit,
Yep.
and we got her to. I did a recipe to figure out what'll get the best outcome if she paid off a certain amount of debt. We got her score up by 60 points, and it resulted in a much better mortgage outcome for them. So, if you come to me and have me run the credit report and your credit cards are maxed out, you're going to have a pretty poor outcome on your credit scores. But that's very fixable.
Yep.
Late payments, I can't fix those.
Yeah.
Inquiries, where people keep checking your credit, you go to Raymore again or car shopping, out looking for new credit cards and so forth. All that sort of way chips away your scores. We have a very special technology that we use, which does what's called a soft pull. So it's not going to leave fingerprints on your credit report that anyone looked at it. And it's not going to alert all the telemarketing outfits out there that you're out looking for a house or to buy a mortgage, to get a mortgage.
How many?
So,
I have a question though. How many times can you do a soft pull?
I don't think there's a limit, Jackie. I mean, I wouldn't do it more than once
Yeah.
in a 90-day period of time. There's no reason for me to run it again and again and again.
Okay.
All
Okay.
right. So I run that credit report. It's good for 90 to 120 days.
Okay.
All right.
Yeah.
It's if they're shopping, all over God's creation, then the next lender, they may or may not have that soft credit pull technology. So they get what's called a hard pull, which is going to leave an inquiry. It leaves fingerprints on your credit report, which,
Right.
it's not the end of the world. But if it takes you from a 740 down to a 729 because you went to the sixth or fifth or seventh lender,
Yeah.
then you're kind of sorry because that probably just cost you another $1,000 in closing costs.
Yeah. So
Yeah.
that's a good point there. You get people to, because you get it all the time. People are out shopping different lenders and shopping rates and seeing who's going to help them, see, who's going to, give the best outcome, give the best deal for them. So that's a good thing to say to point out. They keep getting those hard pulls and they're going to spend more on closing costs. So
Yeah. Well,
there
it's
you go.
also, it's a lot of, you can't just quote a rate anymore. Like I used to go around with rate sheets, to all my realtors back in the day. I do what's called the milk route, where we go out there. Here's my 30-year fix, and they match it up to the other guy who was just there a half hour ago,
Yeah.
and see where you stand. Now it's like because of this grid, I can't honestly answer anybody when they ask what my rates are. I'm like, well, I don't know. What's your credit score? What are you buying? A
Yeah.
condo, a two-family, a summer home?
Right.
What's your down payment? What's your loan size? So all these variables will affect it. And then the last two things I didn't talk about are, bankruptcies, judgments, collection accounts. Those could all have a devastating impact on your
Yep.
credit report. And then there's
Wait, am I
makes
like
you.
ahead of you here? Hold on. Sorry.
No, I think.
There you go. Yeah. All right. I'm on the right one. Sorry.
Okay,
I
it's
got
all
ahead
right.
of you there. So, okay. Bankruptcy judgment. Okay. Next, you want me to go on to the next one? Here we go.
Sure.
we got our buyers, the 4 types of buyers.
Yeah. So the 4 quadrants of the buyers. Here's like your most qualified. This is a $250,000 salary. Him and a couple or even just single person making very good income. Credit score over 760. Down payment greater than 20%. They've got job stability for 2+ years. They are savers. They're buying a single family home. That's who the rocket mortgages of the world are targeting, those types of buyers. And it's interesting, like even one of your clients commented that she had gone to Rocket, and I'm like, yeah, it looks like they really trained you well. Right?
Mm-hmm.
Because they make it, you just go on your phone and you apply it, make it seem so easy, but everyone forgets they're never discussing rates ever. Okay, Rocket,
Right.
when they were Quicken, used to advertise rates all the time. Not any longer. They're never discussing rates. They're talking about speed. They're talking about convenience and
Mm-hmm.
how instant gratification. That's what they're all about. And that's this box of borrowers. The first quadrant, that may be just fine for them. Or they may be leaving some money on the table because they didn't shop around and they just like working on their phone. That's great. I've got that technology too.
Mm-hmm.
And, I can say, okay, I've got the technology plus, a loan officer with 40 years experience that also, can help answer your questions. So you get, 2 for the price of 1 in that sense. But
Right.
the technology really is incredible, what we do. And we're very advanced with that.
Yes, you are. Yes, you
The,
are.
the next quadrant is, their salaries are 150,000 or so. Credit scores, 700 plus. Down payment might be less than 20%. They could have variable compensation, so they may have smaller salaries, but then they have commissions and bonuses that sort of swing wildly.
Yep.
Scrappy savers. By that I mean, they may have to, go under the couch cushions to find more money for down payment. They may have to tap into their 401k to come up with a down payment, extra monies, things like that.
Yep.
Gifts for down payments, but they're good buyers, but they need more work. This is where I think, where an online lender is going to fall short, because you need to have advice how the income is going to be looked at, how you can
Mm-hmm.
maximize the outcome, how you get your savings all put to where they're supposed to be at the time you apply for your mortgage, so there's no surprises or disqualified assets, and you're left in a very bad situation. So we help with that.
Yep. Okay.
Um, the next quadrant,
Awesome.
the third quadrant, I'll call it.
Yep.
Clever me. Um, so these salaries are 120,000 or so. You're 10,000 a month. Credit scores are 680 and up, and your down payments are 5 to 10%. It's variable compensation, so it could be a salary plus commissions and bonus again. A lot of self-employed are in this bucket. Scrappy savers again, gifts for down payments. There's perhaps divorce situations where there's income coming in from child support or alimony, or it's outgoing where you're paying alimony, child support.
Right.
And these buyers could be looking at condos, 2 to 4 families, as well as the single family homes. So they need more help from a loan officer to help navigate what is going to get them the best outcome. So these buyers are still are in the picture and are very, very helpable. And then we go to the fourth quadrant, which is people under 100 grand.
Yep.
They've got a combination of, let's say, a full-time hourly job and a part-time job where they haven't had the same jobs for 2 years,
Yep.
that sort of thing. Their credit scores, like I said, could be under 680. They may have had a bankruptcy. Their down payment could be 3 to 5%. Back to the scrappy savers. They need gifts. They need down payment assistance. There could have been a very traumatic, situation in their life that caused, bankruptcy or short sale or foreclosure. So life really kicked them around quite a bit. But they just don't have like a strong positive, whether it be income or large down payments, and plus the pricing of the homes today on top of the higher rates is really a challenge for these buyers.
Mm-hmm.
Um,
Right.
so where do they go? I'm having success with them, but it's further out west.
Right.
Going out, the Upper Passaic County, out to Sussex County,
Right.
um,
Yep.
where the homes are more affordable. But there's challenges there because half the houses have 40 or 50-year-old septic systems that have to be replaced,
Yeah.
or wells. So we've got to carefully tread that so that the sellers either agree to put in the new system, or we have to do a renovation loan, or we have to wait until that septic system's in, or they
Exactly.
offer all sorts of goodies with seller concessions to try to free up cash so these buyers can replace some of these things themselves. So
Right.
that's their challenge.
Yep.
And then the affordability table I did here.
Yes. This is
Okay.
interesting. This is
Now
what I
here
was
I
waiting
did,
for.
I did 5 price buckets,
Yep.
that are probably meaningful to people on this podcast right now. So a $600,000 purchase price. Everything here I'm using is 20% down. I'm using taxes, based upon my experience in Northern New Jersey, what the typical taxes will look like. So, you look at a $480,000 mortgage, that's at your $600,000 purchase price, and the taxes and insurance about $1,075. The income needed to afford that is about $150,000 a year to just squeak by and get a $600,000 home. Now, if you have no debts, you could probably squeeze more out of that. If you have a typical car payment and a bunch of student loan debts and a credit card, I would allow for about $750 a month in like a car lease plus a credit card and some student loan debt. If it's much higher than that, if the student loan debts or the cars are like pretty luxurious brands and you're up around 700 and per car, that's going to eat into your purchasing power.
Exactly.
Yep.
Exactly.
So, here's your range going, $125,000 income gets you a $500,000 home. Now I drop it down another 50,000 to a 450 purchase price, and about 115 gets the job done.
Yep.
At 400,000, 106,000, and that's using today's rates. I use 7.5 as the rate.
Okay.
And then I went as low as 350 because there's just not much out there below that price point.
Yeah. Well, in Jersey there isn't.
Right.
But yeah, it's like you gotta like get out of here and like go somewhere Midwest to get something under 350.
Yeah, but there are certain jobs, Jackie, where people can make the drive. If you got to be to the city every day, you really can't go much further past 280, the 287 belt.
Yeah.
Once you get outside that belt, that's just grueling. If you have to be at work in the city every day, but if you're lucky and perhaps you're working in Paramus or Parsippany area, Rockaway, where there's a lot of corporate headquarters, you're okay. You can go out west, further out Route 80. That works fine. But cops, firefighters, nurses, people that work like, let's say 3 or 4 days a week because they have like 3 12-hour shifts in a row, and then they have 4 days off. Those folks might be okay going all the way out to Pennsylvania.
True.
And I've done that. That they just have a place to crash when they're working. Mom and dad, grandma, grandpa, or sister, brother, somebody. An old roommate.
It's crazy what people are now, what the extremes that people have to go to get a house to be able to afford something, right? They gotta
drive
go
to you can afford.
Yep.
That's the thing, right?
So, all right, Bob, we got some more comments here. Let me just let me stop sharing this. Let me pull these comments up here. Okay, this is Tea with Kara. Hi, Tea with Kara. We were chatting before. I did get your email, by the way. I'm going to say that for my next one. I read the story. I'm like, I was under the gun. I had to get on. So I will share your story next time. But anyway, Tea with Kara says, if 120K a year need help, what about people making less than 40K with 2 people working?
So you have 2 people working, making $40,000 a year. Um, on your own, I don't see how you probably would be looking at, and if you had no debt, at most $100,000 mortgage.
Okay.
That would be my prediction. And your taxes would have to be under 3,600 a month. I mean, a year, under 3,600 a year.
Yeah, that's not happening here.
Yeah, no, I
That's
mean,
not in
it's sad.
Jersey.
So what we do, Jackie, in cases like that, where I've got, sometimes their parents are very involved and want to lift their kids up. I've had, parents co-sign with, their kids just starting off and knowing that their income, power will increase over time
Right.
while they're getting started. Uh, Usually it's a working parent, they're in their 50s or 60s, they're still working, not someone who's in their 70s or 80s, that is on, Social Security only or a small pension, and
Right.
they got to live where they got to live. They typically can't help unless they've got a really sweet package,
Yep.
having retired. But generally, a working, parent, without, with their mortgage mostly paid off or all paid off, um, can get you back in the game. But that $40,000 income is going to be a challenge.
Yes.
But there are, there are places where there's USDA loans, which are no down payment mortgages
Yes.
in certain parts of the country. They're they're very prevalent in upstate New York, and probably north and west of Orange County, New York, I would say. And then going out to the Poconos,
Yep.
out by Scranton, you could probably find the USDA product would be very helpful for somebody like that, because no
Right.
down payment, it's income restricted, and there's no mortgage insurance on those products. So those are pretty cool.
Yep. All right. We also have somebody comment here. This is Sidewinder. Is there a chart for retirees? So
As far as their income
I
is
guess
concerned,
income. Yeah, I guess they're looking for like income and what they can afford. I mean, I guess.
um,
Like,
no, because the income that I'm stating on that doesn't necessarily mean salary. So if I say
it's
someone needs to make,
anything, right?
it's
Yeah.
anything. So, let's say someone had to make, they want to buy a house for like, they want to move down like Tom's River, Forked River area, right? That's a
Yep.
big retirement area. Um, they want to borrow 320,000, need 106,000. So if you're both getting Social Security, if you both work to retirement age, that could be, combined like $40,000 right there, right? And
Mm-hmm.
then if they were, city or state town workers, educators, firemen, worked for some Fortune 500 company, or had a nice size 401k, you could get that income up, add another 50 or 60,000 to that, and they'd be fine. They probably don't have a lot of debt. So yes, there's no reason retired people can't buy homes. And
Right.
we could give a 30-year fix to someone that's 100 years old. We
Yep.
never discriminate because of age. So all the above. It could be interest income, dividends, annuities that you may have purchased that are going to pay out for at least 3 years. Social Security, we actually average it up because it's not taxed like regular income.
Right.
Yeah, for sure.
Okay. Awesome.
Yeah.
All right. And we have chicken soup for dinner. Hello. It's been a while. How much does the type of place you were buying affect it compared to everything else? I assumed a loan for primary residence was for any residence before. So I'm assuming she's talking about like buying a second home or vacation home,
Yeah.
right? Is that
So if you bought like a vacation home, and let's say the rate example I'm using here is 7.5%. Um, I mean, this table for income goes out the window because you probably already have a mortgage, or if you don't, you own a place or pay rent as your primary residence. So you got to have more income than what you see here for that size mortgage. But the other half of that question is, where would the rate be? This rate would still be 7.5, but you'd probably be paying, instead of 2 points, you might be 3 or 3.5 points for that same rate. And
right?
1 point equals 1% of the loan amount. So in our example here, if it's a $400,000 mortgage, figure $4,000 per point as closing cost.
Okay.
So you'd be 3 points would be 12,000. Would be $12,000 on a $400,000 mortgage just in points.
Okay.
Okay.
Yeah. Okay. So moving on, we have our hand. How common is the 20% down? I'm in North Halden, looking at like 6 to 700K for a house around here. That is a total gut job. Sales in adjacent towns, 8 to 9, even over a million. Otherwise, I'm in quadrant 1. So, in my experience, and I'm sure Bob will say the same thing. I mean, lately, I do see a lot of people putting the 20% down, especially in that higher price point. It does, um, it it does make you look better, more attractive to a seller. And I have people over the years that put less than 20% down buying a $900,000 house. It's doable. But you don't have to do 20%, but in this market, if you got it, put the 20% down,
Well,
right? Because you're also saving on PMI too. You don't have to pay the private mortgage insurance.
but Jackie,
So,
let's say the house needs a lot of work. Let's say, it's 600. North Hallen is a great town, by the way. You get a lot of bang for the buck there for sure. Um, but the taxes are high. But all that, we'll put all that to the side. If a house, you can get it for 600,000, but it needs 100,000 of upgrades, bathrooms, kitchen, and so forth. If you put down 20%, that uses up half your budget that you're going to do to renovate it. So you could, indicate you're going to put down 20% to get the offer accepted. If the house appraises okay, and you are, as you said, quadrant 1, there's no reason you can't get 90% financing after the appraisal comes in, as long as a commitment says, here's your loan approval, everything's been met, the contract stipulations have been met. So you basically waive your rights to the approval anymore because you already got it. So I need 30 days to get a mortgage commitment. Here it is. It's a bigger mortgage than I said, but the seller should not care because all the unknowns are now known.
right.
Um, so yeah, 10% down. PMI is really very inexpensive with good credit, like we're talking in quadrant 1. It's probably going to cost you, about a quarter of a point to 3/8 of a point extra, and that'll go away in anywhere from 5 to 12 years, depending upon how much you put down. But
Right.
it also improves the rate slightly because the Fannie Mae has like a partner with the loan with the PMI companies that if you go into default, they get 20% of their losses covered by the PMI company. So they reward the cost of financing a little bit. And you can prepay these loans anytime. And that goes to another point. I always was a proponent of 0-point loans. But it's hard to do that now because the market has dried up for people buying mortgage-backed securities. I'm asking my own stockbroker. I'm like, hey, why can't I just buy these mortgage-backed securities? I mean, I'm out there lending at 7%. That means there's a coupon out there getting a 6.5% yield. That's pretty damn good. Why can't I get that?
Right.
He doesn't even know where to find it. I'm like, it's like the world's worst. It seems to be a
That's
secret out there, but
weird.
I don't know. But
Yeah.
he's finding out. I'm trying to find out. I'm just like shocked that, you know,
Yeah.
that normally in a market like this, when you can get 5% CD rates, and yet mortgage-backed securities are guaranteed by the government, right? You're going to get paid once a month, a little bit of the, mostly interest, a little bit of principal, but that's a good investment.
Yeah.
And, the rates, anything that's at 7.25, after the government takes its haircut, the investor is getting paid like 6.5% on that coupon.
Right.
That's pretty good.
Yeah.
You know?
It's really good.
But you
I don't
figure
get
if it
that.
was more available to the public, they'd start buying those mortgage-backed securities, which would drive down the cost of financing. But
Yep.
for some reason or another, these two worlds are not they're not connecting for some reason, and they're not being sold securities. They're not readily accessible to the public. I can't explain it. I'm baffled.
Yeah, that's weird. I
Um,
don't I
but
think it's all part of the plan, I think.
right. Well,
It's all part of the plan.
getting back to the best quadrant and so forth. Two things: people that buy for cash and they think they'll finance later are going to pay a heavy price. Now you have to close twice. You have to wait about 6 months to a year, depending upon the product you want, to get some of that money back.
Yeah.
All right. So it's more efficient to just get the mortgage when you're buying the house. The purchase mortgage gets a better rate than a refinance, especially a refinance on a property that had no financing. It's known as a cash out refinance. Those cost more than a purchase money mortgage, just by the
Hmm.
way. So cash buyers, I always warn them, like, all right, you better not need money anytime soon, because when you do, you're not going to be able to easily get it, nor can you get it quickly.
Right.
Um,
It's funny. So speaking of loans, somebody had a question down here, and there was something else I wanted to right here. I wanted to address also. The question: didn't the Federal Reserve approve 40-year mortgages? Are they being given now? Now they're not. That whole 40-year loan thing that was for people with FHA loans to recast, right? It was
yeah,
or to reset the terms if they were on the verge of possibly going to bankruptcy or not bankruptcy, yeah, whatever, defaulting on their loans. They had that option; they can recast that term to 40 years, right? But there's no new 40-year loan.
not with Fannie Mae. There
No,
are 40-year products, but their rates are already like a percent higher than a 30-year. So whatever savings you thought you were going to get gets eaten up
no,
by a higher rate. So it's self-defeating. Um, it's like, an interest-only product. It's for the wealthy. Those are people getting $1 million mortgages
yep,
and higher that are putting down 30, 40, 50%. They get to choose those type of products.
right.
you know the rest of us, with our traditional mortgages, are not getting those sort of options. The adjustable rates, you may notice, are gone. They're not even being offered.
I know we talked about that. I can't believe that. But
Yeah.
but hold that thought because somebody commented about the arms. I'm going to share that later. Um, but I want to get onto this one. GT Oberfest. Can you elaborate more on how the point system works for investment properties?
Yeah. So I don't know if I'll be able to do this, but if you purchase a home with like 20% down as an investment property, expect to have to pay about 5 points for that just to get a mortgage. So because of the pricing hits on that chart, if they have it, go to that Fannie Mae LLPA chart.
Yep.
It'll show you, there's a special chart just for investment properties, and if they're multifamily, they're going to be even more expensive. But a you're paying. There's layered risk premiums added to the cost of financing. Now, in the past, we used to be able to offer 0 point loans. In fact, we got paid nicely that they had figured that a loan was going to stay on the books for like 7 or 8 years.
Mm,
So they would pay us like 5 years worth of the servicing value. And so we could offer 0 point loans to our clients. And in some cases, we could absorb the losses, or some of the hits they take by raising the rate a bit and letting that extra premium cover the cost of the points. That's not happening now. Because these loans are so easily paid off, because the internet has just made refinancing for any reason ubiquitous. There's no stickiness to these loans, so
right.
it costs $7,000 to book a loan, and then it needs to take about 15 months worth of payments to recoup what it costs to put it on the books, and these loans are paying off in 6 months, 8 months, 9 months.
Wow.
So the losses were just tremendous. So
Yeah.
the investment community is like, screw this, we're out. We're not paying up anymore for this. We're not paying up for anything. So, or
Hmm.
you're going to pay points and you're going to like it. That's basically that's it. Um, they've stripped away the adjustables. The rate mortgage platform is gone. Fannie Mae doesn't, they're offered, but their rates are costing 4 points just to even put a quote out there at a rate that's worse than a 30-year fix. So they're just telling you, we don't have it. There's no market for it.
Wow, I can't.
Yeah.
That blows my mind. So to hold that thought, because what I wanted to share this with you. I wonder if it's on here. Right. So this was what I wanted to talk about as well. So this is a comment on my video today, where if you have again, if you haven't shameless plug, if you haven't seen it, go back and watch it. It was posted. It was posted yesterday about how this market will not be like 2008. It'll be more like 1980. This person commented, it says, he says here, 90% of households are paying less than the current rates on their mortgage. 62% of homeowners have a mortgage rate that's less than 4%, and 23.5% pay less than 3%. That is creating a big dam to availability, especially when coupled with higher mortgage rates and increased institutional acquisition and ownership of rentals. Look for an increase in ARMs and even a push to 40-year mortgages, which we just totally said that they don't exist. I feel sorry for first-time buyers. This may be a generation that simply doesn't get to own a house. I mean, yeah, okay. But I love how everybody's going back to, they're just going to put out the ARM loans. We're going to put 40-year mortgages out there, and that's what's going to cause everything to blow up, right? That's what's going to, especially the ARM loans. I just find it interesting now they're not even offering it.
Well, think about this: if you made mortgages more affordable, what's going to happen to the prices of homes? They're going to keep going up faster.
Right, kind of like student loans when the government put out the student loans, right?
Yeah.
That's why colleges are so expensive now.
Right. Well, this is the month that, I don't know how many millions of people, my kids included, are starting to have to make the payments on their student loans now.
Yep.
So that's going to disappear, $200 or $300 a month from their budgets.
Yep.
We'll see how that cooks into the formula. But they're right about, the people with the 3 and the 2s and the below 4% rates. The stickiness of those homeowners is going to be a big, big problem. And they've noted that, when we talk about in our world, the servicing portfolios, those coupons are not paying off like normal. They're very slow to pay off. We used to blow through if you had a portfolio of of 1,000 mortgages, within 5 years, they were pretty much all gone. They all refinanced out, sold, whatever. Like the money go around just kept going. Now, because these rates are so low, you will see home equity loans going on top of those. It's happening already. And you're seeing record high credit card debts.
Yeah.
Right. So everyone's not touching that rate because it's so precious, but something else is giving. So you go hit an equity loan, you borrow another 150,000 to consolidate the credit cards you ran up, and that's at prime plus something. Prime is 8.5, right? So those rates are variable, and that can be easily 9 or 10% on those products. So something's going to give. It's not right away, but ultimately, the front end of the boomers are going to start aging out. I'm at the tail end of the boomers. I am officially a boomer, but I feel like Gen X, honestly.
Yeah, really.
With all the scraps we get from the boomers.
You'll always be Gen X.
Yeah, I know.
I always look at you as Gen X. You're my people.
They're just wreckage everywhere you go. But they're like, where are the baby boomers now? They're like 75-ish. They're approaching 75. What's Mick Jagger? He's like 80 years old now, right?
I know. Who'd have thought? What the hell? All right, here's another comment. I wanted to share this one. Again, another person commented on my video that I posted yesterday. We are in stagflation, just like the late 70s, early 80s. We're going to see 12% mortgages soon, maybe even 22% or higher. Every asset class is in bubble range and permanent money has nowhere to go. So they stay where they are at. Prices become so sticky that it takes decades for prices to come down enough to free up the market again. The real estate market freezes up in an unaffordable range. Just like the last time this happened, stagflation is a free market failure that the free market fundamentalists believe cannot happen. The invisible magic hand of God goes on vacation. Supply and demand are meaningless. The market simply seizes up and fails. What say you, Bob?
I didn't know Glenn Beck was on your podcast. How about that?
Right? I'm like, okay, that's great. So the stagflation, I agree with him. I agree with that. I think that we're there.
The inflation's cooked in. The only thing that could cause inflation to go down is energy prices. I mean, that's the headwater besides government spending, which is ridiculous. But
Yeah.
besides government spending, the other thing pumping the pedals on the bicycle is energy prices, because everything from products that are made to moving things around, revolves around the cost of producing energy and getting it out to the public. So, what could cause this bubble to pop? What could cause rates to go? It would be, contagion of this, like take this Israeli conflict, right? God
Yeah.
bless those poor people in Israel. But
Yeah.
if that war were to say break out, and now Iran's involved, and all of a sudden everyone's taking up sides, and it becomes less contained, you'll see mortgage rates drop,
Yep.
flight to quality sort of thing. But that's like doomsday stuff. That okay, great, I get to refinance people, but I hope I'm alive, to
Yeah.
enjoy the low rates sort of thing. But
Yeah.
everything always, all kidding aside, good times feel like forever, bad times feel like forever. I count this as sort of a challenging time, a bad time. I think policies that have been in place prolong this. I thought that the prior administration, when we had that housing implosion, I think really dragged their feet on letting us get out of that malaise. And then we kicked ass for several years,
Yep.
till the virus. That's just it. It's just always things are going to hit us left and right.
Yep.
I don't know how you get, other than aging out, which the boomers are ultimately going to age out. So
Yes.
that's one factor. Nobody lives forever. The millennials are probably a bigger demographic of buyers out there. So,
Yep.
ultimately, they're going to be homeowners, I think. What was the other part of that? It was a loaded gun of comment there that I gotta
Where did you go?
break it apart. And
I know. Hold on a minute. Sorry. Oh my God. Sorry about that. It was just saying that he's saying that it's for stagflation is a free market failure that the free market fundamentalists believe cannot happen. Yeah, I mean, basically, yeah, I think you pretty much answered it. Prices become so sticky that it takes decades for prices to come down enough to free up the market again. I mean, it could take decades. I don't know. I don't know. But look,
well, Jack, there's policies that let's say let's say they're correct. How would you shake that loose? What would you do?
Oh, my dog. Sorry.
Well, I mean, here's like an idea you can say. You could increase the tax deduction for interest on mortgages.
Hold that thought. You be quiet. Sorry. My dog. Sorry, everybody. Go ahead, Bob.
Okay.
Shut him up.
Yeah. So there could be policy changes that would encourage people to sell. Like, let's say you lift the capital gains tax on your residence. So right now it's currently $500,000.
Yep.
So if people are sitting on $1 million of capital gains, and they're holding off on selling something because they're gonna have to pay tax on it, maybe you put some goodies in there that would encourage them to sell the house. You could also discourage interest. You could also get rid of deductions, which I think would be horrible. But I think you can improve deductions for the interest on mortgages, as an example. Right now, for a married couple, the interest deduction is up to $750,000 of a mortgage, and I think $375,000 for a single. So you could change policies. Right now, our market's capped at $10,000 state and local taxes, right?
Yes.
That could change. So that might, help.
Yep.
They could decide to build more housing, which fat chance with that one. But I think, you just simply create more supply. But it's so hard between all these competing regulatory agencies to get anything done. I just don't know how that solution gets through. They can't do anything because there's 8,000 departments of getting nothing done out there to get nothing done. Yeah.
It's ridiculous.
Yeah.
Shh, be quiet. Yeah, such a big bark from a small dog. I know, he's a pain in my butt, this dog. Anyway, somebody, I just had some other comments on here that just popped up, Bob. We got good discussion going on tonight. Fast NA, it's been a while. How are you? Everybody who wanted to wait it out lost out big time. You cannot time the market, period. You long term, you always win. Listen, I agree with you. And these are the conversations I'm having with my buyers now. You know, they do, like, should we wait it out? Like, well, here's the situation. If you wait for the rates to come back down, you're back in that whole bidding war times 10, you know, because everybody's going to come back into it again and the prices are going to go even higher. So, you know, it's so if you can do it now and refinance later, and I hate saying that, but it's the most logical thing to do is just that's what I would do, because the prices are going to go up from there. So that's, I mean, Bob, do you agree with me? I think once these rates come back down, if they come back down,
Yeah.
it's gonna be a frenzy again.
Yeah, I agree. So what we've been doing for let's say the last 2 years, we'll refinance. Let's say something goes into the high fives, mid fives. Maybe that's where it's supposed to be.
Yeah,
But yeah, that'll certainly keep us busy.
yeah,
But I don't think waiting works in your favor. Um, I just don't see that. I don't see anything that would cause a housing bust. As you just saw the criteria we put buyers through.
yep,
It wasn't like it was in 2006 and 7, where you could have marginal credit, no proof of income, no proof of funds, and just get a house because you wanted to.
that's right.
And they just kept building more and more, and you just live off of inflation of houses. Today's buyer is the most well qualified buyer we've had ever.
Yeah,
So, you know, and things could go bad, and maybe values could drop 5%. But if people are primarily buying to live there as their home, like, why would you panic? And it's not like you mark to market and have to sell your house because the value drops suddenly, like you would on a margin account with stocks.
yeah,
Or like commercial banks when they're looking at their shopping malls that they've lent to and they dropped in value, and have to force a sale, a liquidation. It's not like that. If that's your primary residence,
mm-hmm,
that's it. You just ride it out. You need shelter,
yep,
and that's it.
yep,
Um,
yep.
uh,
Um, all right. GT Oberfest says here, following up, after primary and secondary home, is the third home automatically considered investment, or can that be additional residence? That could be an additional residence, right?
well, it has to be. I get people that try to buy a house in the same town, telling us it's going to be a primary residence, and sometimes that's true. If you're going from like a $500,000 value house, and now you're going to buy it on the other side of town, it's going to be $1 million and change. That could be a primary, but you're going to
Mm-hmm.
have to tell us what you're doing with the other house. You get to play that card once.
Okay.
All right. So if you keep
Yep.
trying to collect properties and each time it's primary residence, it's not going to fly. But maybe you get to play that once because your family has grown, better schools, or your living standards now want a larger house, etc., a pool, you name it. But no, after your second home and your primary, you could have another second home. It has to be in what's called a resort area, lakes, mountains, beaches. Think that.
Yep.
Um, not Jersey City, New Jersey, not Parsippany, New Jersey.
No.
That's not a second home
Right.
area. And there is no Lake Hiawatha, by the way, in Parsippany. It's
There
just
is.
a name. I lived there once.
There is no Lake Hiawatha.
There's no Lake Hiawatha in Lake Hiawatha.
Well, what the hell?
I don't know. It's false advertising.
Yeah, really. Now they tell us. Just want to see if our hand just wanted to. We're going to throw this last comment up. Man, we are like way over tonight. So, in North Jersey, there's tons of empty commercial space. Why not convert to housing? Every main street is littered with empty buildings. Listen, I agree with you. And now that we have all these companies doing work from home, there's a lot of empty space out there. But you look at these office buildings, what are they going to be converted to? They're going to be converted to probably condos or apartments, or, I mean, I would think they would be more so becoming apartments because, they can get all this rent on them. Because that's been the talk about this past year. Like a lot of builders now are building multi-unit dwellings because now people are just gonna be renting. So
Yeah,
that's another, that's something else. And Bob, down at the Garden State Plaza, they're
I was
going to
just
be,
gonna say.
yeah, they're adding living space above the mall. Like, right? Is that what they're doing? Is going above the mall?
Yeah, I think my sister's gonna be the first buyer there.
Really?
No,
Why?
she's a Short Hills Mall girl.
Yeah.
That's why.
Oh,
No,
yeah. No, no.
no,
But yeah, but that's what they're doing. That's what they're
I know.
doing.
I saw the brochure. They're building like a town square, like attachment to the Garden State Plaza. But you know what? That's some people like that. You just breeze right. You never have to go outside. You just sashay down to the Cheesecake Factory or wherever you're going to go. You want to go have lunch there or
I
shop.
guess, but so the traffic just in that general area is a nightmare as it is. What the hell is that going to do? How many units are they putting in there? I didn't even know how many they're building, but I
I'm
mean,
not quite sure, but I'm not sure you ever leave the place. Who's the profile buyer there? I don't know if it's like 30-year-olds or is it like 70 or 80-year-olds? I
I
don't
don't
know.
know. I don't
But
know. I think it's
I agree.
crazy.
Like you would think, like with the housing, there's an apartment shortage in New York City. A lot of those empty office buildings, and I know they've talked about it, but I think to retrofit those for residential use, um, they've looked at them. From what I've heard, I don't know that a lot of them make sense. The cost to do that, I don't know.
Mhm.
I always thought the Fashion Center would be ideal for because they got the new Valley Hospital there as an example.
Yeah.
Um,
Yep.
to have like senior housing near there with some retail space would be a nice combo unit there. But
Yeah. I don't know.
uh, yeah, no, but I agree. That would be great if you could do that to just repurpose things um,
Yep.
for today's living because you don't need all this office space. It's just
No.
there's just way too much of it.
And let's face it, some malls are going to be going under eventually too. I mean, Paramus Park Mall, I go in there, it's like there's so many empty stores now, and it's like, what are we doing? Like everybody's shopping online now, and I don't know. I don't see that lasting much longer. And and I finally, speaking of malls, I finally went to the American Dream Mall on Saturday. Have you been there?
Uh,
That mall?
the one in Secaucus,
Yeah, the one in
in the
Rutherford
Meadowlands.
that has
I,
the indoor skiing and the Nickelodeon water
what'd you think?
park.
How was it?
It's a mall. It's a it's a really, really big mall. I went to, speaking of, so I went to meet my friend Christina Smallhorn, who is a YouTuber. She was in the area, with her kids. So she took her kids to the mall to go skiing, to the indoor skiing thing. So I met her there. I don't know. It's like, it's a mall. It's a friggin' mall, I don't know. There's rumors that that place is going to be going under too.
That thing's been bankrupt 5 times over.
Yeah, and
That
it's like
whole complex. They
it's
keep
still
trying and
standing.
trying.
I know.
I
I
don't
don't
know
know.
who got bribed how many times to keep that project alive. It's just been a boondoggle from day one.
I know, but
But no, I've not gone there. It looks like a big teenage. Oh, you there?
yeah, we
It
lost
looks
you.
like, yeah, it looks
Oh,
like a
there you
big,
are.
like I'd be swallowed up by gangs of roving teenagers there. I just and
Yeah,
preteens.
yeah,
I've
pretty
just had no
much.
interest in going there.
Yeah, I didn't think it was that impressive. I mean, I guess it's this big entertainment mecca because you have like it said, the skiing, you have the ice skating rink, you have the water park there. Great, but I don't know how that one's going to survive. But I digress.
Son of Palisades Mall.
The son of
Right. That big Ferris wheel, I think has like one light bulb left on it. And
yeah.
I don't even think it moves.
Yeah, but I remember when they built that mall too, but it was like such a big to do, and now it's like, ugh, like I don't
Yeah.
wanna go in
Yeah.
there. But anyway, all right, Bob, this was awesome stuff. My God, it's an hour and 19 minutes. This is great. It's good to be back. It's good to be back, my friends. Good to be doing this again. So I'm going to be putting Bob's information in the description box. You can contact him if you have any mortgage related questions. He's happy to help. And if you are wherever you're watching this from, If you need a real estate agent in the area where you are living, or you moving, you say you want to move from Jersey, moving somewhere else in the country, there is a link in that description box that you can get connected to a real estate agent in that area. And they will be happy to help you. So please be sure to click on that. So Bob, this is awesome stuff. Thank you so much.
Thanks, Jackie.
Good to have you back. It's been too long. I haven't been down here since what, June? So it's good to
Yeah,
be
it's been a challenging market for sure, but you know, with the professionals like us, you know, we'll get through it, and
well,
we'll be on the other. So we'll be
right.
there for everybody when we get through the other end and getting through this. Also, mention I'm licensed in 6 other states, so I can help
Yes.
Florida, South Carolina, New Hampshire, Pennsylvania, Connecticut, New York, California.
Awesome.
Yeah, so if people have questions there, Pennsylvania as well, in case I didn't say that. But anyway, thank you,
Wonderful.
everybody. Look forward to seeing you again.
All right. Thanks, Bob. Everybody have
Bye.
a good night. Take care.